All right, welcome back to eXp Realty Minnesota. I'm Justin Campbell, and I'm back again with David Kosmecki, and we are going to be going over what's happening in the mortgage rates. Welcome back, David. How you doing today?
I'm doing fantastic. How are you doing today, Justin?
I am doing good. It's a Friday. It's a little cold and rainy, but it looks like we got some good weather this weekend, so I'm excited to get out there and show some houses.
There you go. Yeah, we're going to be available all holiday weekend as well. If you have any buyers that need to get pre-approved or need a pre-approval letter, we are going to be available. So
Awesome. Awesome. I think as an agent, having somebody available so we can get those pre-approval letters or so a client can reach out and talk with their mortgage lender before we write an offer is super important, especially because it's a really stressful process and there's a lot of moving parts. So it's nice to have that availability.
I agree. And when I sold real estate eons ago, that's what I always wanted, and I could never find a loan officer that was available on nights and weekends when my buyers are. And so when I started my career in the mortgage business some years ago, I made it a point that that I'm going to be available. I'm going to be the guy that I wanted to find. So here I am.
Awesome. So big question of the day, Dave, what are the mortgage rates?
There you go. Well, we're finding obviously credit scores, loan sizes all have an impact on that. But as a general rule, we're finding government loans, FHA, VA, those types of financing. Typically, you're going to be in the lower sixes today. And a conventional, Fannie Mae, Freddie Mac conventional, is somewhere bordering 7%. And I'm not quoting an exact rate because there's factors that go into, is it at 7.25? Is it 6 7/8? Is it 7? And that's the credit scores, loan to values, and loan sizes make a difference. But that's a general rule. But when you compare, FHA, for an example, has a fixed amount for mortgage insurance, a fixed percentage, whether you're a 520 credit score or whether you're a 780 credit score. Conventional, being that the insurance is through private insurance companies, varies based upon loan to value and credit scores much more than FHA does. So we can find that if the buyer qualifies for conventional and they go FHA, they're going to get a lower rate. But when you factor in the mortgage insurance, the payments come out pretty close to about the same. But FHA has some distinct advantages over conventional, and conventional has some distinct advantages over FHA. So which program is right really depends upon the buyer's scenario.
And it depends a lot on the house as well, if it's depending on how competitive it is on whether or not. So one of the ways to get around the mortgage premium insurance on the FHA would bring 20% down. Is that going to cut out the mortgage insurance portion?
Not on FHA, but on conventional, it certainly will. On FHA, you're going to have mortgage insurance regardless of the loan to value. The factor that's used for the insurance may adjust slightly if it's a shorter term or larger or a lower loan to value, but you're still going to have mortgage insurance regardless throughout the life. But you know, there's other factors. For an example, we had a buyer this week that I pre-approved, and he could have went FHA or conventional. We went conventional, and then he was going to buy a condo near Lake Bedamakaska. I think that's how you pronounce it. I'm still having trouble with the Native American name, but he was going to buy a condo there, and he was asking me my advice on what he should do, and I talked him out of buying it because I mean, I know I'm in the business of financing, but the point was there was a lawsuit against the builder because the home was built about 17 years ago, the project, and there's some structural problems with the parking garage. And the parking garage is on the first floor or in the basement. And so they haven't addressed what needs to be done because they're still in a lawsuit who's going to pay for it. And my question to him was, assuming the building doesn't collapse before it gets fixed, because it's an unresolved issue.
Yeah. You may not even be able to get through underwriting in a situation.
I have to do a special program for that. But I had said to him, let's assume it's going to stay standing, but it's going to cost you 30 grand. Would you pay 30 grand more for this property? And he said no. I said, well, then I wouldn't make an offer. And so
having a problem in the state, maybe it's a bigger problem, but we're looking at it from our problem here in Minnesota, is that on some of these HOAs, we're not able to get insurance on the property. And so what I'm doing as a habit is typically, if I am going to see a condo or townhome that has an HOA, is to shoot that over to a lender, shoot it over to Dave and say, hey, is this property going to be able to get underwritten? Because it's a big problem.
Well, what's really crazy is I heard that there might be some issue, but I didn't know what it was. And so I called the listing agent and asked the listing agent what's the issue. And he said, oh, there's no issue that he's aware of. And then he's going to write the offer, and the buyer's agent heard back from the association with a write-up that this is pending. And so then he backed out. And I think it was the right thing to do. And that's, if he asked my advice, and I gave him my advice. And it's what I think people need to know is, when you work with a good real estate agent and you work with a reputable mortgage person, and you're going to ask them their advice, it's not about selling the property, it's what's best for the buyer. And working with you, I found that that's who you are, and that's who I am. And I think buyers need to know there's a distinct difference between one lender and another, and one real estate agent and another. As you had said in our conversation prior, you met with another lender and they felt a little slimy. Well, sometimes it's only about the transaction, and who cares about the buyer? Well, you do, and so do I. And I think your listeners need to know that that's who they're working with if they choose to work with us.
So where are our rates currently historically? If we look at, where were we at the same time last year?
Last year we were about a half a point higher.
Okay. So we're trending down overall over
it's not a straight line down. In December, our conventional rates went up to about a little over 8% for a short time. And then they went back, then they started coming back down. And so I believe they're trending down.
Mm-hmm.
There's two things happening. One started, what is today, the 24th? One starts on the 31st, and one starts on the 1st of June, which will positively make an impact on mortgage rates. One, the Treasury, for the first time in 23 years, has decided, starting at the last day of May, they're going to start buying back Treasury bills. They're taking them off the market, consequently leaving buyers in more demand who want fixed interest investments to buy more mortgage bonds, thereby creating more demand. The second thing that's happening is the Fed has decided that they're not ready to drop rates yet. All the talk is it's probably going to start in September. They'll probably do a quarter point drop on the federal funds rate, which will impact all credit cards and car loans and have a direct impact in the market on mortgages. But in the meantime, right now they own trillions of dollars. In the last, with our last president, they were buying bonds. They were creating funny money because they print money. Mm-hmm. They're the ones that create money, and they were creating money and buying mortgage bonds to create more demand in the market to push rates down. And consequently, that's a problem. We've got to deal with that because that diluted the dollar value in the world. But what the Fed has been selling off about $90 to $100 billion worth of these bonds every month, putting it into the market. And what they've determined now is they're going to stop selling bond, selling off their bond inventory. And there's about 90 billion of runoff every month, which means people are paying off mortgages and stuff like that. They're going to slow that down. Well, they can't stop people from paying off mortgages, but what they can do is replace some of that runoff with new purchases. And it was just announced that starting June 1st, they're going to reduce the runoff from 90 billion to about 30 billion, which means not only are they not going to sell off 100 billion a month in mortgage bonds, creating more demand for the new ones, they're also going to buy back 30 of the 90 billion that's being run off. And so the combination of what the Fed is doing and the Treasury is doing will indeed create more demand for the bonds, the new bonds that are out there, forcing, when there's more demand, you have to give the buyer of those bonds less money. So it forces the interest rates, the bond yields will dip a bit, and the mortgages that are going into those bonds can have less interest on them. So it'll force rates down directly. So that'll force rates down, because in every pre-election period, rates get better. I mean, everybody seems to know that. And
well, it's kind of unfortunate that we as consumers, that we're impacted in our wallet based on the election cycle and perception, which perception is 90% of how people view the economy. They've done everything that they can possibly do. We are running red hot, and the interest rate hikes, in my opinion, haven't cooled anything off as anticipated. And so it's scary when we're in a position where I feel they've done everything possible to try to cool the economy down a little bit, and it appears to not be working. And so they have to do something to try to hedge against that, because I don't know that consumers can continue on at this pace. I can't, the cost of food and groceries and everything else is hitting people hard.
Some things have come down. Gas prices have come down. I just saw an article on TV, the news, at airfare is down 5.9%, but food is up, and that's something people see, whether they're going out to eat or whether they're going to the grocery store. They see that in their wallet in a big way, and the government hasn't done anything in that arena. So I think the perception is that the economy is not as good as it should be. Yet when this, and I'm not, it doesn't matter what president you're for or not, that's immaterial. But looking at the perception, like you said, perception is people's reality. They remember in the prior president, the first 2 years, where he was pushing the economy, pushing the Fed and everything to boost it, and took us in $7 trillion in debt in those first 2 years. Well, of course, if we're spending more money on consumers and the economy than what we have coming in versus prior regimes or the current regime, of course we're going to feel better. But they don't remember the pandemic as part of that, which really was bad. And so the current president has brought it a long way, but still not good enough for what the consumer wants, because they liked that $7 trillion in debt that we went, because it allowed us to have lower tax rates and forced a lot of prices down at the expense of being tremendously in debt. And people don't look at that, because that doesn't affect their pocketbook. And I understand. I felt the same way.
We're in the alternative now, where we still have a lot of federal debt, and now we're building consumer debt, right? So that's
a big deal.
Yeah. So if it's more if you're in debt and we're in debt with the government, which when we say government, that's we the people, right? So we are in debt. We are doing these things through the government acts. And so It does leave a lot of people feeling very vulnerable. I think, especially in election years, it does leave us feeling a lot of unknowns, and those unknowns create instability. But I think, from a real estate agent perspective, people still have to purchase homes. They still need to purchase groceries. And even though these rates are a little bit high, the goal was to try to slow down the economy a little bit. And on a bright side, what it's done is, even in a high demand, low inventory market, we're still able to win on offers, right? We're still able to get deals through.
Right.
And if we have
Exactly.
rates come down 5%, 5.5%, it is going to get so hot again as far as purchases. You're going to be back in a situation where you're writing 20 or 30 offers to get a home. Nobody wants to go through that, right? So from my perspective, again, we're still in that same point where we were a month ago, which is basically, if you want to purchase a home, now is a good time to do it. Yes, the rates are not fabulous. They're not 3%, but if rates do come down, you're going to pay more for the house. And when they
Right.
do come down, if you're already in that inflationary act on the inflationary pricing on the home, means that you're going to be able to refinance to those new rates in maybe 18 months or 36 months. So
Exactly. So if you pay $100 more a month for a year versus paying 30,000 over asking price to even have your offer considered, because all those buyers that had parked themselves because they didn't know what to do are going to come back in the market when rates come down. I'd rather spend $1,200 than 30 grand, because that 30 grand you pay over asking
at 5% is, going to come back to bite you again. It's $1,500 amortized over the course of the year. So in the end,
and that's lost equity.
mhm.
That's money that you didn't get versus paying a little bit higher in payments in the short term, is a smarter bet, and cheaper. Because if you stay renting, well, I'll just rent. Rents are going up like crazy. I mean, I'm seeing people pay rents that are equal to what a house payment is today.
I mean,
It,
some are
it
more, some are more. I mean, and they're raising rents. And if you're renting right now and you're coming up on a lease date here in the next 90 days or 180 days, you better believe that they are going to be raising your rent. And
right.
it could be a large amount. Well, I got to run. This has been a great opportunity to talk with you a little bit about the rates. I appreciate you coming on. Any last thoughts you want to throw out there to potential buyers considering the market?
Get pre-approved first, before you start looking at property. You want to know exactly what the terms and conditions are going to be before you go out and look, because it's fun to look at the shiny new things, but if it's something that you end up can't afford, what you can afford, you'll never be happy with. So you're better off to know where you fit first. And we're available. We can do this online. Go to apply.bookdave.com. You can start an application, download my phone app, start it. Takes 10 minutes. I'll reach back out to you and we'll go over some numbers. Easy, non-invasive. You can do it after dinner. You can do it anytime. And we do weekend and daytime appointments. So we're available when people are. So that's my last point.
Awesome. If you got any value from this video, please take a minute, subscribe, like the video. If you have any questions or things you'd like to see in future videos, throw a comment down below. David will get a copy of the link here, so he'll see those comments as well, and we can maybe answer those questions for you if you're looking to just do it in a more casual way. Also, you can reach out to either one of us. I'll put our contact information in the description below. Thank you so much for jumping on to today's video. I'm Justin Campbell. That was David Kosmecki, and we will see you in the next video.